Your bank is counting on you never seeing this video. Because the strategy I'm about to show you, it's completely legal, it works, and it costs them money every single time you use it. And that's exactly why they'll never ever tell you about it. Hey, welcome back to American Credit Guide. I'm glad you're here. Look, I don't do clickbait. Everything I'm covering today is real. It's stuff I've actually used. And by the end of this, you're going to look at your credit cards in a completely different way. So stay with me. This one actually matters. I need you to stop whatever you're doing right now, because what I'm about to tell you is something your bank has been hoping you never figure out. I'm serious. I've been in the personal finance space for a while now, and I've seen a lot of tips, tricks, hacks, all that stuff. But this is different. This isn't about finding a card with a slightly better rewards rate. This is about understanding how the entire credit card system is actually designed and then using that design against itself. And once you see it, you genuinely cannot unsee it. Okay, so let me take you back a couple years. I had a friend, smart guy, engineer, makes good money, and he was always complaining about his credit card debt. Not a crazy amount, like $400-800 on 2 cards. But he'd been paying the minimums for almost 2 years, and every month he'd look at his statement and go, "I'm paying all this money and the balance barely moves." Sound familiar? Here's what he didn't realize, and what most people never realize, is that the minimum payment system isn't designed to get you out of debt. It's designed to keep you in debt, just barely comfortable enough that you don't panic and pay it all off. That's not a conspiracy theory. That's literally the business model. Banks make more money when you carry a balance. They make more money when you only pay the minimum. They make more money when you don't understand how interest accrues daily, not monthly, daily, on your average daily balance. Most people think the interest hits once a month. Nope. Every single day your balance sits there, interest is quietly stacking. But wait, here's where it gets interesting and a little bit infuriating. There's a strategy that's been quietly used by people who actually understand credit. And I mean the people inside the industry, the people who write the fine print. And it revolves around something called the statement cycle gap. Most people have never heard of it. I hadn't for years. Here's the thing. Your credit card has 2 important dates that most people mix up. There's your due date, the day you have to pay by, and then there's your statement closing date, the day your billing cycle ends and your balance gets reported to the credit bureaus. These are not the same day. Usually they're about 21 to 25 days apart. Now here's where it gets powerful. The balance that gets reported to the bureaus? That determines your credit utilization. And your credit utilization makes up about 30% of your FICO score. So if your statement closes with a high balance, even if you pay it off in full before the due date, your credit score takes a hit. Every single month. You could be doing everything right, paying on time, never carrying debt, and still be quietly tanking your own credit score without knowing it. So what do you do with this information? You time your payments differently. Instead of paying right before your due date, you pay down your balance before your statement closing date. That way, when the balance gets reported, it's low, or even 0. Your utilization looks great. Your score goes up. You're not doing anything sketchy. You're not gaming anything illegally. You're just understanding how the reporting cycle works and using it to your advantage. My friend did this for 4 months. His score went up 41 points. Same income, same spending habits, same cards, just different timing. Banks know this works. They just don't advertise it. Because a higher credit score gives you more leverage to negotiate. Better rates, better cards, better terms. And that costs them money. Now let's talk about the second piece of this strategy, because this is where most people really leave money on the table. You've heard of sign-up bonuses, right? Spend $3,000 in the first 3 months, get 60,000 points, that kind of thing. Most people treat those bonuses as a nice little perk, a cherry on top. But people who actually know what they're doing treat those bonuses as the primary reason for opening the card, and they plan their spending around it with surgical precision. Here's what I mean. Let's say you've got a big expense coming up, a car repair, a vacation, new appliances, a medical bill, whatever. Instead of just putting it on whatever card you already have, you time it, or you open a new card 2 to 3 weeks before that expense hits. You meet the minimum spend requirement with money you were already going to spend. You get the bonus, And then, this is crucial. If the card has an annual fee you don't want to pay long-term, you either downgrade to a no-fee version or cancel before the second-year fee hits. Done right, that's anywhere from $500 to $1,200 in value from a single card in a single year. From money you were already going to spend, on stuff you were already going to buy. Most people don't know this, or they know it vaguely but think it's too complicated to actually execute. It's not. It takes maybe 2 hours of research up front and about 20 minutes of management per month. But here's the twist, and this is the part that surprised even me when I first dug into it. The credit card companies? They know exactly what type of customer you are within the first 60 to 90 days of opening an account. They have behavioral models. They're watching how often you swipe, what categories you spend in, whether you pay in full, whether you carry a balance. And based on that data, they decide how aggressively to market to you, whether to offer you a credit limit increase, and yes, sometimes whether to quietly reduce your limit or close your account. They call certain customers deadbeats. That's actual industry slang for people who pay their balance in full every month and never pay interest. Because those customers cost the bank money, they get the rewards, they use the benefits, but the bank never collects the interest or the late fees. So if you're playing this strategy well, you're technically their least favorite customer. And weirdly, that's a badge of honor. Now, I do want to be real with you for a second, because I know someone's going to come into the comments and say, this only works if you're already good with money. And look, there's some truth to that. If you're someone who genuinely struggles with overspending, adding more credit cards is not the move. This strategy assumes you can track your spending, pay your balances on time, and not get seduced by the rewards into buying things you wouldn't otherwise buy. Because the bank is also banking on you slipping up, every time you miss a payment, they collect a fee. Every time you spend more than you planned because I'll just put it on the rewards card, they're winning. The strategy only works if you stay disciplined. The credit card is the tool. You're the one using it. And honestly, that mental shift from this card gives me rewards to I am using this card as a strategic financial instrument. That's the real change. That's what separates the people who come out ahead from the people who end up with a drawer full of cards and a credit score that never seems to move. There's one more thing I want to mention before I wrap this up because I think it's massively underrated. Your credit card's benefits, not the rewards, the actual built-in protections and perks that are buried in the benefits guide that nobody reads. We're talking things like purchase protection, where if something you bought gets stolen or damaged within 90 to 120 days, the card will reimburse you. Extended warranty protection that literally doubles the manufacturer's warranty on electronics and appliances. Trip cancellation insurance. Rental car coverage. Cell phone protection if you pay your phone bill with the card. I know someone who got $700 back on a laptop that broke 2 months after she bought it. Not from the manufacturer, not from the store, from her credit card's purchase protection. She had no idea the benefit existed until a friend mentioned it. That's money sitting right there in your wallet right now, in a benefits guide you've probably never opened. So here's what I want you to actually do after watching this. Find out your statement closing date, not your due date, your closing date. It's usually somewhere in your online account or the fine print of your statement. Start paying attention to when your balance gets reported. And if you've got a big purchase coming up in the next few months, look into whether it makes sense to open a new card to capture a sign-up bonus on that spend. And then go read your benefits guide. I'm not even joking. Set a timer for 20 minutes and just read it. You will find something in there that surprises you. The system is built to benefit the banks by default, but the rules are the same for everyone. You just have to actually learn them. If this was useful, hit subscribe because I cover this kind of stuff regularly. Real strategies, not just save money on coffee advice. And drop a comment if you tried the statement closing date trick and what happened to your score. I genuinely read those, and it helps me know what to cover next. Look, the system isn't rigged against you. It's just not designed to explain itself. But now you know. Find your statement closing date this week, check your benefits guide, and if this helped you even a little, subscribe to American Credit Guide. I put out this kind of real, practical stuff every week. See you in the next one.